Welcome back to the deep dive. I'm willing to bet that you, our listener, are probably watching one number a little closer than any other on the charts right now. Silver.
That was a big one.
It is. You have a target in your head. Maybe it's $100? Maybe 200. That's the number, right? The retirement number, the freedom number.
It's the number where the long, long wait finally pays off.
Exactly. You're waiting for the free market to finally wake up and acknowledge the true value of your asset.
And that expectation
Yeah.
right there, that's the illusion we need to shatter today.
Okay.
We have to be immediately cynical about this. Because the moment the real value of a strategic asset like silver starts to threaten the government's control over its currency or its supply chains,
The free market sign comes down.
it comes down fast. Before that official price ever gets close to 3 digits, the rules of the game will be rewritten. Free market gets replaced with a much harsher term, national security.
This isn't just a theory, though. This is a playbook. We've seen it before.
Oh, absolutely. Look at 1933, gold confiscation, Executive Order 6102. They just said, sorry, we need this for the public good.
And we saw it again, maybe a little more subtly, but just as effectively, in 1980 with silver.
History shows us that in a real crisis, the state just performs a legal edit. They don't need to ban it. They just need to make it legally impossible for the official price to match the real value.
And that's the pivot point for today, because the stakes are so much higher now than they were back then.
Exponentially higher.
Silver isn't just a hedge against inflation anymore. It's a critical component. We're talking about the guidance systems in missiles, the infrastructure for AI, high-speed computing.
It's the bedrock of the entire military-industrial complex. They cannot function without it.
So if you put your own personal wealth goals right up against the Defense Department's need to secure that exact same resource.
The question just answers itself, doesn't it? I mean, do you really believe they're going to stand by and let a bunch of investors and, stackers trigger a massive price squeeze on a vital military component?
No. They're going to act.
They will act.
So our mission today is to dig into exactly how they'll act. We're calling it the price control trap. We're going to use 3 really foundational economic laws, Gresham's law, the Cantillon Effect, and the Pareto principle, to show why the official price of silver might never be allowed to hit $100.
Even if it's real, in the shadows, price is, far, far higher.
The core thesis, and it's a cynical one, is this. The price isn't the problem. The law is. To really get a handle on the future, we have to look at the past. And there's no clearer example of this kind of government intervention than what happened with the Hunt brothers in 1980.
Right. And the official story, the one you get in business school, is really just a simple morality play.
Agreed. Right. 2 rich guys tried to corner the market and got what they deserved.
Exactly. Rich, arrogant speculators, over-leveraged, destroyed by their own hubris. It's a neat story, but it's fundamentally misleading. If you actually study the mechanics of the trash, it was a government-sanctioned intervention, a bureaucratic takedown designed to save the financial establishment from going bankrupt.
Okay, let's break down that timeline. From 73 to late 79, the Hunts were buying. A lot. Physical silver, futures contracts.
And they weren't wrong. They saw the inflation coming. They distrusted paper money. They were making a very accurate bet on the debasement of the dollar. And they pushed the price from, $6 an ounce up to nearly $50 by January 1980.
Which created a huge problem for the people on the other side of that trade.
A catastrophic problem. The big banks, the commodity houses,
Yeah.
they were all massively short silver.
So just for our listeners, what does it mean to be short in that context?
It means you're betting the price will go down. You sell a contract promising to deliver silver in the future, silver you don't actually own yet. The idea is you buy it back cheaper later and pocket the difference.
But when the price skyrockets instead?
You're facing ruin. The banks were on the hook to deliver silver at $50 that they had sold for, 10 or 15.
Yeah.
They didn't have the metal. They were looking at imminent system-collapsing bankruptcy.
And this is the moment. This is when the so-called free market, which is supposed to allow for failure, was suddenly deemed too dangerous to exist.
Precisely. The COMEX, the Commodities Exchange, stepped in. And this wasn't a natural correction. This was a deliberate, targeted, legal intervention. The exchange stopped being a neutral platform and became a weapon for the establishment shorts.
So what did they do? Specifically, on January 21st, 1980, what was that bureaucratic edit?
They implemented something called the Silver Rule, and this is the detail that matters. The rule declared all trading in silver futures to be liquidation only.
Liquidation only.
Meaning the Hunts or anyone else who was bullish were legally forbidden from buying any new contracts. You couldn't roll your position over, you could only sell.
So it's like they just turned off the demand side of the equation.
Instantly. By fiat. Demand was strangled. But they didn't stop there.
They went further.
Oh, yeah. At the same time, they jacked up the margin requirements for holding existing contracts. Margin is the good faith deposit you have to keep with the exchange to hold your leveraged position.
And I remember reading the figures were just brutal. It went from a reasonable amount to something like $6,000 a contract almost overnight.
That's right. And for someone like the Hunts, who held contracts on millions and millions of ounces, this meant they were facing massive, sudden margin calls. We're talking millions of dollars they had to come up with immediately.
Even with their wealth, they couldn't meet those calls.
No. They were forced to sell their holdings just to raise the cash. They were technically insolvent on paper because the rules were changed mid-game.
Now hold on, because the critics always say, well, they were over-leveraged, they should have managed their risk. Why wasn't this just the exchange protecting itself?
Because you don't change the rules at the 50-yard line, just because your preferred team is losing. If they had allowed the banks to fail, the market would have corrected. It would have been painful, but that's how a market works.
Right.
By imposing liquidation only and hucking the margins, they weren't stabilizing anything. They were engineering a forced price crash. They were using regulatory power to crush a legitimate market signal to save their friends. The free market was completely irrelevant at that point.
So the crash that followed, Silver Thursday, the Hunt's downfall, it wasn't supply and demand. It was a bureaucratic takedown.
100%. And that's why 1980 is such a chilling and cynical warning for today. If they were willing to tear up the rule book just to stop some banks from losing money.
Imagine what they do now when it's not about bank balance sheets, but about the Defense Department getting the materials it needs for missiles.
It's a totally different ballgame. We've moved from protecting profits to protecting, as they see it, geopolitical supremacy. So if silver even gets near $80 or $90 again, you have to expect intervention.
But what would that look like today? It probably wouldn't be as blunt as a liquidation-only rule.
No, they have much more sophisticated tools now. The big one is the Exchange Stabilization Fund, the ESF.
Run by the Treasury Department.
Right. It has immense and, frankly, opaque powers. It can operate in currency markets, gold markets, and, crucially, it can be used to hammer commodity markets through derivatives.
So instead of a public rule change, the ESF could just become a ghost in the machine, an invisible, infinite seller of paper-silver contracts just to keep the price down.
Precisely. They create artificial supply on paper. And on top of that, they can just create regulatory hurdles that make taking physical delivery of the metal almost impossible. They won't need to ban silver. They'll just make sure you can never, ever get the real price for it through any official channel.
Okay, so the moment the government decides the true price is, let's say, inconvenient, and they intervene, that's when we enter the world of our first economic law, Gresham's law.
Yes. And Gresham's law is the key to understanding why their suppression plan works in the short term, but also why the official price they create is a total myth.
The law itself is simple, right? Bad money drives out good.
That's the one.
But let's apply it directly to silver in this kind of crisis scenario. What's the bad money and what's the good money here?
The bad money is the official paper currency, the dollar, that the government can print into infinity. It's also the official government-mandated price. The good money is the physical silver, the scarce, tangible asset that holds value outside of any government decree.
So Gresham's law says when you legally force the price of the good money below its real market value, the good money disappears.
It vanishes from circulation. Let's run the scenario. Say the true global market value of silver, based on everything, industrial demand, monetary debasement, is about $150 an ounce.
Okay.
Then the government comes in, citing, national security or protecting the solar industry. They impose a legal binding price cap on all silver transactions at $50.
So all the screens, Bloomberg, the news, COMEX, they'll all dutifully report the price is $50.
Yep. That $50 is the official price. It's the bad money representation. But what happens in the real world with actual physical metal?
It's gone.
Instantly.
Yep.
It's just human nature. Why would a mining company sell their product for $50 when they know its real economic value is $150?
Yep.
They just stop selling. Refiners hold back their inventory.
And you, the listener, the smart stacker who saw this coming, you're certainly not selling. You're probably burying it deeper in the backyard.
Of course not. The entire official market just dries up. The coin shop shelves are bare. The online dealers all say out of stock. The price on the screen is $50, but the amount of physical metal you can actually buy at that price is zero.
That is such a critical point. The official price becomes a lie. Gresham's law guarantees it. The valuable thing gets hoarded, and the official system just starves.
But here's the kicker. The demand doesn't go away, right? The military still needs it for those missiles. Tech companies still need it. The demand is still there.
So if you're an industrial buyer and you absolutely need physical metal and you can't get it through the legal system, where do you go?
You have no choice. You're forced into the shadows.
Yeah.
And that's the birth of the inevitable black market. The official capped price is the price of paper. The black market price is the price of physical metal. That's where real price discovery happens.
So when our listeners ask the question, will silver hit $100?
Yeah.
The most accurate answer through the lens of Gresham's law is...
Yes, it will. Absolutely. But you're not going to see that price on the TV screen. You're going to see it in the premium someone pays a private dealer in an alleyway. That's the only place you'll be able to actually get the metal.
So the street price becomes the only true price.
It's the only one that matters.
Yeah.
And the spread, the gap between the fake $50 spot price and the real $150 street price, that gap is the price of reality. It's the premium you have to pay to convince someone to part with their good money.
I have to ask, though, couldn't the government just manage it better? Instead of a hard cap at 50 that freezes the market, couldn't they just raise it to 75 or something to relieve the pressure?
That's a fair question. And they might try. But remember their goal. Get the metal cheap for their contractors and stop the market from proving their currency is failing. Raising the cap to $75 doesn't solve the problem if the real value is $150. You're still asking people to take a 50% loss.
So any price below the real price triggers the same effect.
It triggers Gresham's law. The moment they print a law that sets the price below reality, they guarantee a black market, and they make the physical asset vanish from sight. It's baked into the cake.
Okay, so Gresham's law explains why the metal disappears. Our next law, the Cantillon Effect, explains who gets their hands on that scarce, vanishing silver.
Exactly. This law is all about privilege. It dictates the hierarchy of who gets resources in a crisis.
We usually hear about the Cantillon Effect with money printing, right?
Yeah, that's the classic example. When a central bank creates new money, the people closest to the spigot, the big banks, the government contractors, they get to spend it first, before it causes widespread inflation.
While the rest of us, at the end of the line, just get the inflation.
Right. And the same principle applies to resources in a shortage. They aren't distributed evenly. The entry point into the system determines everything.
And in a national security crisis over silver, the government makes itself the ultimate Cantillon insider.
They put themselves at the very front of the line, and they have the legal tool to do it. It's not a secret conspiracy. It's right there on the books. The Defense Production Act, the DPA.
From the Korean War era, I think.
That's the one.
Yeah.
And it gives the president sweeping powers to basically manage the entire industrial supply chain for national security purposes.
Which means they can force a company, like a refinery, to prioritize government contracts over any civilian orders.
That's exactly what it means. The government can issue what are called priority ratings. A DX rating is the highest. If a refinery gets a DX-rated order from the Defense Department, they are legally required to fulfill that order before anyone else's, even if that civilian order was placed a year ago.
And crucially, they get to buy it at what they call a fair price,
which will be interpreted as the official government-capped price. So the military contractors, the Raytheons, the Lockheeds, they get a special pass. They get to bypass the scarcity of Gresham's law.
They get the physical metal at the artificially low $50 price, even while the black market is raging at $150.
The metal flows directly to them, secured by legal force. It goes right into the missiles and the satellites. This creates a legally enforced two-tier system. It's the Cantillon Effect in its purest form.
So Tier 1 is the government and its strategic partners.
Yep. They're insulated. They actually benefit from the price cap. It's a massive subsidy for them, guaranteeing cheap access to a scarce resource.
And Tier 2 is everybody else, the people.
The retail investor, the small business, the civilian manufacturer. You're at the end of the line. You face the empty shelves. And if you absolutely need metal, you're forced to pay that huge black market premium.
This isn't some wild theory. You're saying this is just standard operating procedure for a wartime economy.
It's exactly that. It's documented. It's how resource management is done in a crisis. The law ensures that the scarcity is managed to benefit the insiders first.
Let's make this even sharper. If I'm a mine owner, does the DPA mean a government agent can just show up with a piece of paper and I have to sell them my silver at the capped price?
That is precisely what it means. You are legally compelled to accept the contract and fulfill it. If you refuse, there are significant penalties. They don't have to technically seize it. They just legally direct your entire supply to their chosen partners, and they pay you in depreciating currency at a price they set.
So the cynical warning really holds if you don't physically hold the asset yourself outside of their system.
Then your paper promise, your allocated account, it's just a claim that they can and will liquidate to get the physical metal into the hands of the people they deem more important.
All right, so Gresham's law makes the metal vanish. The Cantillon Effect decides who gets it first. That brings us to our third law, the Pareto Principle. And this explains the final and probably most lasting consequence.
Which is the great permanent wealth transfer.
The 80-20 rule.
The 80-22 rule, yeah.
Mm-hmm.
It basically states that in most systems, roughly 20% of the people control 80% of the assets. Now, a price control trap like this doesn't just reflect that rule. It acts as a massive accelerator. It forces an even greater concentration of real wealth.
Let's look at the two groups. First, the 20%, the smart money. How do they behave when this trap snaps shut?
This group gets it. They've studied 1980. They know the $50 spot price is a fiction. They've already been accumulating physical silver, and they've probably decentralized it. They control, let's say, 80% of the available unencumbered metal.
And their strategy is do nothing.
Exactly. Just wait. They refuse to sell into the official market at a huge discount. They become what's called the patient capital.
Now, contrast that with the other 80%, the masses.
This group generally relies on the mainstream news. They trust the official price they see on TV. And crucially, a lot of their exposure to silver is through paper products. ETFs, pool accounts, things inside the traditional financial system.
And when the price cap hits, they're under immense pressure.
Tremendous pressure. They might panic sell their physical holdings because they see the official price is capped at 50 and they're afraid it's going to zero. Or, even worse, they get pressured by patriotic appeals.
Do your part. Sell your silver to support our troops. That kind of thing.
Exactly. So the masses are convinced to trade a real, scarce, tangible asset physical silver for a fixed amount of paper currency, the very currency that is being debased and causing the crisis in the first place.
And this is the core of the wealth transfer.
It's the silent mechanism. The government uses its legal power to acquire real assets from the general public at a massive, legally mandated discount. And the smart money just sits back and watches this happen, letting the government liquidate the holdings of the uninformed.
It's cynical, but it's brilliant in a way. The wealth gets centralized in two directions. First, the government gets its strategic supply immediately.
And second, the 20% who held onto their physical metal are now positioned perfectly for the next phase.
Which is when the crisis eventually passes.
Right, because all price caps in history eventually fail. They destroy production. So years later, when the cap is finally lifted, the true market price explodes. Maybe it goes to $200, $300, but by then the vast majority of people no longer own the asset.
They were cashed out years ago with $50 bills that have lost most of their purchasing power.
They're left behind. It's an enforced, structural transfer of wealth, driven by a government intervention that was sold as a way to create stability, but which ultimately just concentrates real assets into fewer and fewer hands.
Price controls are sold as a tool for fairness, but in reality, they're one of the most efficient tools for centralization ever devised.
It's the perfection of the cynical playbook.
Okay, we have laid out a pretty bleak, pretty cynical case. We've got the history, the economic laws that guarantee this trap works. So now, the most critical part, the playbook for survival. If the state can literally print the rules, how do you position yourself?
The first step is, it's a mental shift. It's cognitive. You have to accept from day one that if an intervention happens, the spot price you see on the screen is a lie.
It's the price of paper, not metal.
It's the price of a promise that they can settle in fiat currency. It is a strategically deployed piece of misinformation designed to confuse the 80%. You have to ignore it.
And instead you have to watch the street price.
The street price, the physical premium, that's the real number. If the official price is $50, but your local coin guy needs $150 in cash to sell you a 1-ounce coin, then the price of silver is $150, period. That's the only reality.
That brings us to the second, and you've said this is the most important, strategy. Physical possession is non-negotiable.
This is the core warning of this entire deep dive. Because if you don't hold it, they have a clear legal playbook to take it. Or, more accurately, to liquidate your position and free up the underlying metal for their partners.
We need to be really specific here. What counts as not holding it? Let's talk about unallocated pool accounts.
Right. An unallocated account means you just have a general claim on a pool of metal held by a bank. No specific bar has your name on it. To the bank, your silver is a liability on their books.
And when the DPA is invoked,
That bank will be legally required to settle its liabilities to meet the government's mandate. You will get a check. You will get cash at the low-capped official price, and the metal itself will flow to the Cantillon insiders.
same logic applies to many of the big ETFs like SLV.
The exact same logic. An ETF is a financial product, a security, operating within the regulated system. In a national security emergency, the funds managers will be pressured or mandated to comply. They will sell their physical holdings. Shareholders get cashed out at the official price. Your paper promise is worthless when faced with a government mandate for the real thing.
So the only real protection from this, from forced liquidation, from the Cantillon effect, is physical metal, held by you, securely, outside the system.
It's the one asset they can't just print more of. And it's infinitely harder for them to take it from millions of decentralized owners than it is for them to just flip a switch on a few centralized exchanges. When the rules change, the person holding the physical coin still have options. They can choose to participate in that real black market price discovery.
What about other smart money strategies? Things like jurisdictional diversification.
That's a huge one. The DPA is a U.S. law. A savvy investor might hold some of their metal in secure, private vaults in places like, say, Switzerland or Singapore, countries with strong private property rights. It's another layer of insulation against purely domestic rule changes.
Okay, and let's say they can't stop the price from rising. What's the other form of suppression? The windfall tax.
Oh, that's highly likely. If the price does break free and hits, say, $100, you can bet they'll come after the profits. They'll impose a special punitive capital gains tax, maybe 50% or more, specifically on precious metals.
And the classic smart money counter to that.
You never sell the asset.
You borrow against
You borrow against it. If your silver is now valued at $100 an ounce, you go to a lender and take out a loan against that high valuation. The cash you get is an income, so it's not a taxable event.
Yeah.
You avoid the tax, you keep your hard asset, and you don't release your supply back into their suppressed system.
So this whole playbook, really, it just boils down to one fundamental truth.
The government can't print silver. That is your edge. It's their one vulnerability. But they can, and they will, print laws. That is their weapon. The lesson from 1980, from 1933, is that the rules will change. Your job isn't to hope they won't. It's to be prepared for when they do.
So to wrap this up, the conclusion here is that the idea of a truly free market, especially for something as critical as silver, is really more of a peacetime luxury.
It's a beautiful theory. But history shows, time and again, that it's rarely allowed to exist when the stakes become existential for the state or the financial system.
And we are moving into a time where silver is just too important. It's too critical for defense, for tech, for currency stability. It's too valuable to be left to the chaos of supply and demand.
The suppression is coming, whether it's through the ESF, the DPA, or something we haven't even seen yet. But it's not some evil conspiracy. It's just cold, calculated national resource management. And it's enforced by the full power of the law.
So the validation for your strategy for holding physical silver isn't seeing $100 on the screen.
No. The true validation is the fact that these incredibly powerful entities are building these complex legal mechanisms specifically to stop it from getting there. The manipulation, the rule changes, the price caps, all of that is the market telling you that the real value is much, much higher than the paper price.
The future belongs to the owners of the physical asset. The ones who understood Gresham's law, who positioned themselves outside the Cantillon effect, and who had their playbook ready for the day the rules changed.
And here's a final thought for you to chew on based on that Pareto principle. If this playbook works and vast amounts of silver are permanently moved from the hands of the many into the hands of a few elites, the 20%. How long before the government realizes that all the wealth they tried to manage with price caps has now been dangerously concentrated by those very elites? And what new law will they invent next when they decide they need that wealth back? That starts a whole new, even harsher round of confiscation.
A question of power dynamics that has been around for centuries, something to think about. Until next time, we appreciate you joining us for the deep dive.